Welcome to the deep dive, everyone. We have a seriously exciting breakdown for you today.
Hello, everyone. Yeah, I'm very glad to be here to unpack this with you.
You're on the Smart Capital School of Financial Literacy channel. And today, we are building something that I think a lot of people are searching for right now.
We are building the ultimate bulletproof buy and hold forever 5 ETF portfolio.
But there is a huge flashing neon asterisk here. We are not talking about your retirement account today.
No, we are not. This is entirely specifically designed for a taxable brokerage account.
Right, which completely flips the script on how you should be picking your funds.
It changes everything. Look, we all know the beauty of a 401k or a Roth IRA, right? You have this protective bubble. Inside that bubble, your money grows tax-deferred or even tax-free.
You don't have to worry about the IRS taking a slice every time a dividend hits your account.
Exactly. But with a taxable brokerage account, you get the ultimate freedom. You can withdraw the money penalty-free at absolutely any time. Want to buy a house? You can use it. Want to buy a car? It's there.
That freedom comes with a trap.
A massive hidden trap. Because outside of that retirement bubble, you are exposed to taxes on capital gains and, crucially, taxes on dividends every single year.
Every single year. So today we are going to unpack the exact 5 categories of ETFs you need to navigate this trap.
We'll highlight specific ticker examples for each category.
And then stick around because at the end we are revealing 3 custom portfolio blueprints based on your age and your risk tolerance.
It's going to be a highly actionable breakdown.
Let's jump right into segment 1, the taxable trap and the foundation of cash. Because this is where a lot of investors make their very first mistake.
The dividend dilemma.
Right. So you look at an ETF like JEPQ, which has been incredibly popular, yields something like 10%. On paper, that looks absolutely incredible.
It looks amazing. But you have to ask, so what? What do you actually get to keep?
Because holding a high-yield covered call fund like that in a taxable account is a terrible idea.
It really is. And the reason is the type of dividend it produces. JEPQ produces ordinary dividends.
Meaning it is taxed at your highest income bracket.
Exactly. If you are a high earner, let's say you're in the 37% federal tax bracket, plus maybe state taxes, that 10% yield gets completely obliterated, you might lose 40 or 50% of that payout straight to taxes.
Ouch. Which brings us to the vital importance of qualified dividends.
Right. Qualified dividends are taxed at the much more favorable long-term capital gains rate. Depending on your income, that is either 0%, 15%, or at most 20%.
So the lesson here is, if you are getting dividends in a taxable account, you want them to be qualified.
Precisely. Keep the ordinary dividend generators locked safely inside your Roth IRA.
Okay, so that covers dividends, but what about the cash reserves? Because a lot of people like to keep some dry powder inside their brokerage account.
Yeah, and the landscape for cash has shifted dramatically.
As of early 2026, where are we parking our cash?
Well, currently, your standard money market fund might be yielding around 3.5%.
Which isn't bad.
It's not bad right now, but we have to look ahead. With the Fed rate cuts that are heavily expected, that yield could easily drop to 1.5% within a year and a half.
So that cash drag is going to get real very fast.
It will. But here is a pro tip, especially if you are a high earner living in a high-tax state like California or New York. Look at an ETF like SGOV. It essentially holds ultra-short-term U.S. Treasury bills. Right now, it's yielding around 4%.
But the kicker is the tax treatment.
Exactly. Because it's comprised of U.S. Treasuries, the income is generally exempt from state and local taxes. That is a massive win if you live in a high-tax state.
That is a brilliant alternative. Before we move on to the actual portfolio categories, we need to issue a pretty hard warning about bonds, right?
Yes. A hard rule: do not hold traditional bond ETFs in a taxable brokerage account.
Why? Because of how they pay out.
Because traditional bond funds pay out monthly distributions, and those distributions are taxed as ordinary income.
Just like the JEPQ example.
Exactly. It's wildly tax inefficient. If you want bonds, put them in your 401k. Keep them out of the taxable account.
Perfect. So the ground rules are set. Let's start building the base of this portfolio. Category 1 is the value and dividend ETF.
This is where we start generating that qualified cash flow.
And I want to enthusiastically explain the dividend snowball here because this is my favorite concept in investing.
Go for it. It's a powerful analogy.
Okay, let's unpack this. Imagine you put $10,000 into an ETF that costs $50 a share, and it yields a reliable 3%.
Okay, so you have 200 shares.
Exactly. At a 3% yield, that $10,000 pays you $300 in dividends over the year. Now, you don't take that money out. You reinvest it.
You let it compound.
Right. So that $300 buys you 6 free shares. You didn't do any extra work, you just got 6 more shares. Now, next year, you aren't earning dividends on 200 shares. You're earning dividends on 206 shares.
And those extra shares buy you even more shares the following year.
It's an absolute avalanche over a 20-year horizon. So, what are our options for Category 1?
The heavyweights here are SCHD for pure, high-quality cash flow. There's also VYM, and then there's VTV.
SCHD is a massive fan favorite.
It is because of its strict screening for dividend growth and quality. But I want to add a nuance here for the high earners. If you are in your peak earning years, you might want to lean heavily toward VTV instead.
Why VTV?
VTV is a value ETF. It still pays a dividend, but the yield is generally lower than SCHD. However, you get excellent downside protection and steady capital appreciation.
Oh, I see. Lower dividend yield means less tax drag today.
Exactly. You minimize your current tax burden while still capturing the value premium.
That makes total sense.
Yeah.
Okay, let's move to Category 2. This is the core, the foundational ETF that anchors the entire portfolio.
The engine of the car.
And I have a historical fact that absolutely blew my mind. If you took a single $100 investment and put it into the S&P 500 in 1929,
Right before the worst crash in history.
literal right before the Great Depression, and you just left it there riding out every single crash since World War II, the dot-com bubble, 2008, everything.
Reinvesting the dividends along the way.
Yes, with dividends reinvested. That $100 would be worth roughly $889,768 today in 2026.
It is staggering. The power of the U.S. economy compounding over nearly a century.
Nearly $900,000 from $100. So for the core, we are looking at the S&P 500 or the total U.S. stock market.
Right. And people often ask, should I buy an S&P 500 fund, which is about 500 of the largest companies, or a total market fund, which is around 4,000 companies?
What's the verdict?
Historically, they move almost identically. The top 500 companies make up so much of the total market's weight that the performance is nearly indistinguishable.
But there is a detail that really matters when picking the specific ETF.
Fees. Not the share price, the fees.
Yes. Let's talk about the share price illusion.
This trips up so many people. They look at an ETF like SPYM, which tracks the S&P 500, and it might be trading around $80 a share.
Then they look at VOO, which also tracks the S&P 500, and it's up near $600 a share.
And the instinct is to think SPYM is cheaper. You can buy more shares, so it must be better.
But it doesn't matter at all.
Not one bit. You are buying the exact same underlying asset. It is like asking if you want a pizza cut into 8 slices or 16 slices. It is the same amount of food.
The only thing that actually impacts your wealth is the expense ratio.
Exactly. SPYM has an expense ratio of roughly 0.02%. VOO is 0.03%.
Which is incredibly cheap for both.
We are talking about basically a $1 difference in fees for every $10,000 invested.
Insanely cheap. And what about VOO versus VTI, the total market fund?
They are neck and neck. Over the last 25 years, they have historically averaged between 10.3% and 10.74%. You really cannot go wrong with either as your core holding.
Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
Moving on to segment 3, we are expanding the horizon. Category 3 is the international ETF.
Now, international stocks had a really great run in 2025. They actually beat the U.S. market for a stretch there.
They did, and it got a lot of people very excited. But I have to play the voice of reason here.
You're telling people to curb their enthusiasm.
Curb your enthusiasm. Absolutely. Yes, 2025 was a strong year, but we need to look at the 25-year average.
Which is what?
An ETF like VXUS has only returned about 6.32% annualized over a 25-year period.
Wow, compared to the 10.5% of the U.S. market, that is a big drag on performance.
It is. So why do we hold it? We hold it purely for diversification. VXUS gives you exposure to over 8,500 international companies.
We are talking about massive global players.
Right. Companies like TSMC, ASML, Samsung, Tencent. You want a piece of that global pie just in case the U.S. market goes sideways for a decade.
But we keep this allocation small.
Very small. It's a hedge, not your primary growth engine.
Got it. Which leads us perfectly into Category 4, the broad growth ETF. This is where I want to dial up the risk just a little bit to hunt for those higher rewards.
And the best way to do that is generally by tracking the NASDAQ Q100. It is tech-heavy, It's innovative, and it grows incredibly fast.
So everyone immediately thinks of QQQ. That is the famous ticker.
It is, but here is a highly actionable insight. Do not buy the classic QQQ for a buy and hold portfolio. Buy QQQM.
Okay, why QQQM? What is the difference?
They track the exact same index. They hold the exact same tech giants, Apple, Microsoft, NVIDIA, plus non-tech growth companies like Walmart.
So if it's the exact same holdings, why switch?
Because QQQM was specifically designed for retail buy and hold investors with a cheaper fee. It charges 0.15%. QQQQ is more expensive.
In over 20 or 30 years, that fee difference compounds massively.
Exactly. There are also some great alternative options in the broad growth category if you don't want just the NASDAQ.
Like what?
SCHG is fantastic. It has a tiny 0.04% fee and boasts an impressive 18% plus 10-year average return.
18% average over 10 years is incredible.
There's also VUG, or if you want something really interesting, SPMO.
Oh, SPMO. I consider that one a bit of a unicorn.
It's a momentum ETF, right?
Yes, it tracks momentum stocks, and it's been a unicorn because it somehow captures this massive upside while still offering surprisingly strong downside protection during corrections.
It's a very solid alternative for that growth sleeve.
All right, now we are getting into segment 4, the spicy stuff. Category 5 is aggressive growth.
And we should explicitly state that this category is optional.
Very optional. These are the wild cards. We're talking about sector-specific or speculative plays here.
Right. For example, SMH, that is the semiconductor ETF.
Which has had a massive 33% 10-year average return. 33%.
It's unbelievable. But, and this is a huge, but it could easily drop 50% in a single year if the global supply chain chokes.
Yeah.
If one geopolitical event happens near Taiwan, SMH will plummet.
High risk, high reward. Another one is XME, the metals and mining ETF.
That one is fascinating.
Yeah.
It shot up 100% in a single year recently. But if you look at its historical average, it is only around 6.6%. It is highly cyclical,
And then, of course, there is IBIT for Bitcoin exposure.
which is the definition of a speculative wildcard.
So out of all the aggressive options, what is your top pick if someone really wants to allocate to category 5?
My top pick here would be VGT. It is the Information Technology ETF.
Why VGT over the semiconductor fund?
It is slightly less volatile than pure semiconductors because it is broader. It holds over 300 tech companies across a variety of different subsectors.
So you weren't just relying on chip manufacturers.
Exactly. You get software, hardware, services, and it still boasts a phenomenal 23% 10-year average return.
That is huge. Okay, so we have our 5 categories: value and dividend, the core, international, broad growth, and aggressive growth.
But picking the right ETFs is really only half the battle here.
The percentages dictate your success.
Exactly. Asset allocation is everything.
Yeah.
Assuming you already have a fully funded emergency fund and you are already contributing to your retirement accounts, we have built 3 master blueprints for this taxable account.
Blueprint number 1 is for the young investor. High risk tolerance, long time horizon.
For this person, we want heavy growth, but we still need that foundation. I would allocate 25% to SCHD for that dividend snowball.
Get the value compounding early.
Right. Then 30% in VOO as your solid core. Only 5% in VXUS for a tiny bit of international exposure.
And the rest goes to growth.
Yes. 25% into QQQM for broad growth and a full 15% into VGT for that aggressive, spicy growth.
I love that. It's aggressive, but it's anchored by the S&P 500 and SCHD.
Exactly. Now, blueprint number 2 is for people in their peak earning years, say your 40s or 50s, with moderate risk tolerance.
And this is where we execute that strategic tax pivot you mentioned earlier.
This is crucial because you are in your peak earning years, your tax bracket is at its highest. You want to avoid ordinary income, and you even want to minimize qualified dividends if possible to reduce tax drag.
So we swap out SCHD.
We swap SDHD for VTV. I would put 33% into VTV. It lowers your taxable dividends, but still provides a rock-solid value base.
That is so smart. And the rest of the portfolio?
25% in VOO.
Yep.
We bumped the international up slightly to 10% in VXUS for a bit more stability. 22% in SCHG for growth and dial the aggressive VGT down to 10%.
It's a beautifully balanced, tax-efficient setup,
Yeah.
which brings us to blueprint number 3, nearing or in retirement, low risk.
Here, the focus completely shifts away from aggressive growth. It's all about safety, capital preservation, and reliable cash flow to fund your lifestyle.
So how does the pie look?
We go incredibly heavy on value and dividends. 50% of the portfolio goes into SEHD.
Wow, half the portfolio generating that qualified cash flow.
Exactly. Then 20% remains in VOO for baseline U.S. growth, 15% in VXUS, and 15% in VUG for just a touch of broad growth so inflation doesn't eat your purchasing power.
And for the aggressive category.
Zero. Absolute zero in the aggressive category. You do not want a 50% semiconductor drawdown when you are trying to pay for your retirement lifestyle.
That is a masterclass in portfolio construction. But before we wrap up, I know you had a final thought about this whole buy and hold forever philosophy.
I do, and it is a critical thinking exercise for everyone listening. We've spent this time building a buy and hold forever portfolio. But considering how much the macroeconomic environment fluctuates,
Like the dramatic drop in Fed rates we anticipate over the next year.
exactly, the global economy is constantly shifting. So the question is, at what point does holding forever actually become a blind spot?
That is a great question.
Right. How often should a quote-unquote forever portfolio actually be reevaluated against the reality of a changing global economy? It's something every investor needs to ask themselves annually.
A brilliant point to end on. Well, that wraps up our deep dive for today. Goodbye, everyone.
Goodbye, and thanks for exploring this with us.
Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling.